This is lecture, this is week 12, and then this is lecture 1, Monday 10th of January 2022. This is still in the topic 6 part 3, which is accounting for current asset inventory. In the previous lecture, you have learned about the definition of inventory, and then inventory recording system, which is perpetual system and periodic system. The basic idea is if you use perpetual inventory system, you have to update account inventory every time every time there is an increase in inventory or a decrease in inventory. It means that every time you sell something or you purchase something for your business, you have to you have to update your account inventory. The second system that you can use to record inventory is called periodic inventory system. If you use the periodic inventory system, you do not update account inventory every time you sell something or you purchase something. But you update account sales and account purchase. I think I have explained in brief these two inventory accounting system in the previous lecture. So today we continue with the way to record purchases according to perpetual system and periodic system. Okay, if you have a business, when you purchase inventory for your business, there are several things that are related to the purchase. The first one is transportation cost. Sometimes you have, let's say you have a grocery shop. If you purchase inventories, sometimes you have to pay for transportation cost. And it is also related to purchase return. So purchase return is something like this. You purchase inventories for your business and then something is wrong with the inventory. Maybe 1 or 2 items are expired. So you have to return that item to the supplier. So that situation is called purchase return. And another thing that is related to the purchase is purchase discount. Sometimes if you purchase in high quantity, you will get discount from the supplier. What else? Another thing is sometimes if you purchase inventory in credit and you pay yearly, if you pay yearly, sometimes the supplier will give you discount. Here you will learn about how to record the transactions related to purchases of inventories according to perpetual and periodic system. See here, under the perpetual recording system, all adjustments are entered directly in the inventory account. But if you use periodic system, when you record purchases, all adjustments are accumulated in an array of temporary holding accounts. That purchases account, freight in account is related to the transportation cost, and then purchase return account related to purchase return, and purchase discounts account is related to purchase discounts. So let's see. Okay. Now we look at the sales. Okay, if you sales are related to sales return and closing entries for cost of goods sold. If you have a business, when you sell something, if you use perpetual inventory system, you have to do two things. First, you have to record the sales, and the second thing is you have to show the cost of goods sold account. on a transaction by transaction basis. So every time you sell something, you have to show the sales or the revenue. And the second thing that you have to show or record is you have to record the cost of goods sold. That is under the perpetual system. But if you are using periodic accounting system for inventory, you only record the revenue or sales account. Okay, let's see. This is an example related to sales. The first example, I think. Okay, in June, Harper's had a business sold 20 hats for $25 each. And this business sell the old ones first. It means that the business sell the inventory that goes in first. If you check the transaction related to Harper hats, there are several times in the months the business purchase inventories from supplier. So when the business sell, the business assume that the business sell the inventory that goes in first, that comes in first. So it sell the old one first. So see here, if the business uses perpetual inventory system to record these sales, first there are two records. See the first yellow box here. The business has to record two things. The first thing is the business has to record the sales. The sales is $500, which is $25 times 20 hats. So the first record is credit account sales $500. Given that the sale is in credit, so the business debit account receivable $500. That is to record the revenue. And then if the business uses perpetual system, the business also has to update the account inventory. So when the business sells something, the thing that happen is inventory goes out or asset inventory decrease. So that's why for this 30th of June transaction, the business has to record credit account inventory $250. Why $250? Because the business assume that the business sell the old inventory first. The oldest inventory in related to this business is at the price of $10 per hat. So the business sell 10 hats at $10 first, and then the second oldest inventory is at $15 cost per unit. So 10 hats at the cost of $15. So total inventory goes out is $250. The inventory goes out is a decrease in inventory, so credit account inventory $250. At the same time, the business has to debit account cost of goods sold. Remember that when the business sells something, you have to update the account inventory. Also, you have to debit account cost of goods sold. But if the business uses periodic inventory system, you have to do the recording like the second box. See that if the business use periodic system, the business only has to record the revenue, which is the date is 30th of June, credit account sales or revenue $500, and then debit account receivable, given that the transaction is a credit transaction. So periodic system is easier. The recording for the recording process for inventory using periodic system is easier and simpler. Okay, let's see how to record sales return using perpetual system and periodic system. Sales return is something like this. The business sells something to customer, and maybe and the customer is not happy, maybe because of the wrong specification or wrong size or damage. So the customer can return the item. It always happen. It happened to us also. Sometimes we purchase something and we go home and we look at it again. We found that the item is damaged or expired or wrong size. After that, we will return the item to the shop. So it happened. So if you have a business and then your customer return an item, that is called sales return. So how to record that? If you use perpetual system, you have to update account account sales, because the sales has to be reduced, and also you have to update account inventory and cost of goods sold. Okay, but if you use periodic system, you only have to update account sales. Let's see how to do that. Okay, see here. The example is for this business again. On July 3rd, one hat was returned from a late June purchase. Record the entries for both the perpetual and periodic inventory system. So using the perpetual system, first record is to reduce the account receivable. Remember in the previous transaction, this business has sold something to customer in credit. So when the business sell that thing to the customer, the business has recorded the sales in account receivable. So when the customer return an item, the business has to reduce the account receivable. That's why you can see in the first journal entry, the business credit account receivable. It shows that the account receivable has decreased by $25. At the same time, the business has to debit account sales return. Account sales return is a new account, I think, for you. You have to know that when sales return happen, a business has to create an account called sales return. In this example, the sales return is $25. And then the second thing for perpetual inventory system, the business has to update account inventory. When the business sell the hat, the business credit account inventory because inventory goes up. Now when the customer return the item, the inventory goes into the business. So the business has to record an increase in inventory. So debit inventory. At the same time, the business has to reduce the account cost of goods sold. Remember, when the business sell the hat, the business has to increase the account cost of goods sold. Now the customer return the hat, so the business has to reduce the cost of goods sold. So debit account cost of goods sold $15. Okay, now that is perpetual inventory system. But if the business uses periodic system, the recording is simpler. The business only has to debit account sales return $25 in this example, and then the business has to credit account receivable $25. That's all. Debit account sales return to record the sales return, and credit account receivable to record there is a decrease in account receivable. So closing entries for cost of goods sold. If you use perpetual system, all journal entries are posted to the ledger. Results in new balances for inventory and cost of goods sold. If you use perpetual inventory system, all the account inventory is updated. Always updated. Always update. And also the cost of goods sold account also always updated at the updated amount. Numbers are verified by physical count. Okay. But if you use periodic system, remember you do not update account inventory and cost of goods sold. So temporary holding accounts are accumulated and added to the inventory. And then inventory account balance is reduced by the amount of cost of goods sold. Okay, we see how to do that. How to do the calculation. Okay, if you use periodic inventory, remember if you use periodic inventory recording system, when you sell something or you purchase something, you do not update the account inventory. This kind of recording system, you update account inventory only at the end of accounting period. And when you want to update the account inventory, you have to do physical stock take. Let's say you have a grocery shop. Most of the time, a grocery shop will use periodic inventory system because a grocery shop sell thousands of items. Some of the items are very small, like needle, candies for kids, very small, difficult for you to use perpetual system. So when you sell something, if you have a grocery shop, when you sell something, you only update account sales. When you purchase something, you only update account purchases. When customer return items, you update the account sales return and account sales maybe. Sales return and cash maybe, or account receivable. But and also if your shop return item to supplier, you only update account purchase return and maybe account cash and maybe account payable. So you do not update account inventory. So for a business that uses periodic inventory system, when the business want to know the value of ending inventory at the end of accounting period, the business has to do physical stock take. The business has to calculate the ending inventory manually by hand. If the business is a big business like big supermarket, very difficult process to do the physical stock take. Sometimes they have to do estimate. Okay, so see the blue box. With a periodic system, a physical count is the only way to get the information necessary to compute cost of goods sold. So when the business want to calculate cost of goods sold, the business has to use the formula in the yellow box. See here, see the cost of goods sold equal to beginning inventory plus net purchases minus ending inventory. You have to memorize this, I think, at this stage. Later, when you learn how to prepare income statement for a merchandising business or a manufacturing business, you will see the logic. At this stage, I suggest you memorize the formula first. Okay, so what is net purchase? Net purchases. Net purchases equal to purchases. Remember when you do the recording, for a business that uses periodic inventory system, when the business record purchases, the business record or debit account purchases. So net purchases equal to purchases minus purchase return plus freight in. You will see this calculation when you need to do income statement for a manufacturing business or merchandising business. Okay. So when you see previous slide, you know that if a business uses periodic inventory system, physical stock take at the end of accounting period is a must. It's compulsory. Otherwise, the business does not know how much is the current asset inventory, current asset and inventory, and also the business will not know how much is the cost of goods sold. But if a business uses perpetual inventory system, Physical stock take is actually not compulsory. Why not compulsory? Because if a business uses perpetual inventory system, every time there is every time the business sells something, and every time the business purchase something, the business will update account inventory, and also will update account cost of goods sold when the business sells something. So when the business close account at the end of the year, the business already has record of how much is cost of goods sold and how much is the ending inventory. So if a business uses perpetual inventory system, it is not compulsory for the business to calculate or to manually calculate the ending inventory or to do physical stock take. It is not compulsory. But still, most businesses that uses perpetual inventory system, they still do physical stock take or manually calculated the inventory at the end of accounting period, because just they want to make sure the number that they have in the cost of goods sold account and the inventory account in the inventory account is equal to the physical number that they have in their shop or in their business or in their store where they kept they keep their inventories. Okay, remember that point. So inventory, the way a business records its inventory, and the way a business show the value of inventory in the balance sheet is very, very important, because see here the first blue box here, an error in inventory results in cost of goods sold overstated or understated, and then the inventory error has the effect on gross margin and net income. So if the business put wrong number or wrong value for the current asset inventory, then the cost of goods sold can be higher than it's supposed to be, or it can be lower than it's supposed to be. If the cost of goods sold higher than it's supposed to be, then the profit of the business will be understated. If the cost of goods sold of a business is lower than what it's supposed to be, then the profit of the business shows in the income statement will be higher than it's supposed to be. So that's why the way a business record inventory and calculate the value of the inventory is very important. The value of the inventory can affect the net profit of the business. So that's why it is very important. Inventory costing method. Inventory costing method is something like this. Remember, when you sell inventory, remember, if you have a merchandising business or manufacturing business, when your business sells something, there are two things that will happen. First, you have to record the revenue. When you sell something, you have to record the revenue. That is easy. The revenue is related to the price that the price of the product. The second thing is, when a business sells something, it is related to cost of goods sold. Cost of goods sold is something like this. The cost of the item that has been sold by the business. So when you want to calculate the cost of goods sold, it is cost of the product sold by the business. So to calculate the cost of product sold by the business, there are several ways or several methods that can be used to calculate the cost of product sold by the business on a certain date. So in this subtopic, you will learn about that method, inventory costing method, the way you can calculate the cost of item or products sold by a business. So see here, there are 3 methods that can be used to calculate cost of items sold by a business. The first method is called first in, first out, or FIFO. The second method is called last in, first out, or LIFO. The third method is called average cost method. Okay. So the figure or the picture that you can see here actually try to show you the logic for each method, but let's see in the next slide. I think you can see the flow, the calculation. Okay, see here. FIFO method. Okay, FIFO, remember, first in, first out. Let's say, see here, let's say a business, let's say there is a business. The business is a merchandising business. The business sells something to the customer. So the business, in the month of May, the business purchases. In the month of May, the business makes 3 purchases. The first purchase is at May 10. On the 10th of May, when the business purchase something, the price of the thing or product is $9. And then the second purchase is on 18th of May. At that time, the product purchased by the business is $13 per unit. And then the third purchase is on the 24th of May. At that time, the price of the product purchased by the business is $14 per unit. So what is the next thing? This is LIFO. Okay, so the thing that happened is like this. The business sells something, sell one item. I think the business sell the item on 30th of May. Am I right? I hope I'm right. So let's say the business sell an item on 30th of May. When the business sell the item at $20 per unit. So see here in the income statement, the business has to show sales $20. That is the price of one item that the business sold. And how much is the cost of goods sold or cost of merchandise sold? Okay, this method, if you use FIFO method, first in, first out, using this method, the business assume that the inventory that comes first will be sold first. So in this example, the cost of goods sold is $9 because that is the first inventory that goes in during the month of May. Says $20, cost of goods sold or cost of merchandise sold is $9 because this is FIFO, first in, first out. So the gross profit for this business is $11. The ending inventory for the month of May using this FIFO is $27. What is the $27? The $27 is the inventories left. The inventories left are two items or two units. First item or first unit is at $13. The second unit is at $14. So 13 plus 14 equal to $27. That is according to the FIFO method. Okay, and then this is the second method that can be used to calculate the cost of inventory goes out, or cost of goods sold. This method is called last in first out. This method assumes that when a business sells something, the last item will go out first. Okay, so see the data is same. There is a business. This business made 3 purchases. First purchase at $9 per unit or per item. Second purchase at $13 per item. The third purchase is $14 per item. So if this business using LIFO method, at the 30th of May, the business sells something at $20 price. So you see the income statement in the first column in the box. Income statement, the sales is $20. The business has sold something at $20. How much is the cost of merchandise sold or cost of goods sold? This business uses LIFO, last in first out. So the last product that goes in will go out first. So the last product that goes in is the purchase at $14 per unit. So the cost of goods sold or merchandise sold is $14. So for this business in the month of May, the gross profit is $6. How much is the ending inventory? The ending inventory is related to 2 product left unsold. The first product is at the price of $9 cost, and the second product is at the cost of $13. So 9 plus 13 equal to $22. That is the second method. Okay, now the third method that can be used to calculate the cost of goods sold and the cost of items sold by a business is called average method. Average method is related to the calculation of average inventory cost during an accounting period. So if you are given this data, there is a business. This business made 3 purchases during the month of May. First purchase is $9 per one product. Second purchase is $13 per one product. Third purchase is $14 per one product. So, and then the business sells something at 30th of May, one item. So how to calculate the cost of goods sold? To calculate cost of goods sold, according to this method, you have to calculate the average value of inventory during the month. In this example, the average is $9 plus $13 plus $14. So it is $36. And then you have to divide the number with the total quantity. So total quantity during the total quantity purchased during the month is 3. So $36 divided by 3 equal to average cost of $12 per unit. So when the business sells something, the revenue is $20, and then when you want to show the cost of goods sold, you have to show it at the average cost. So the average cost for the inventory is $12. So gross profit of this business is $8. So how much is ending inventory? Ending inventory is 2 units. So 2 units times $12 per unit average cost equal to $24. Okay, this is an example. Sample question. The 3 identical units of item QBM are purchased during February as shown below. During the February, this business made 3 purchases. The first purchase is 1 unit at $45 cost. Second purchase on the 15th of February is 1 unit at $48 cost. The third purchase at 26th of February, 1 unit, the cost is $51. The total cost, the total for total purchases is 3 units, and the total cost for these 3 purchases equal to $144. How to get the $144? $45 plus $48 plus $51 equal to $144. So this question also shows the average cost per unit. How to calculate the average cost per unit? $144 total cost divided by the total unit, which is 3 units, equal to $48. Okay, and then the question says, assume that 1 unit is sold on February 27 for $70. Okay, so and then the question asks you, determine the gross profit for February and ending inventory on February 28 using first in, first out, last in, first out, and average cost method. So if you have, okay, I hope you can the answer. Okay, this is the answer. If the business first in uses first in, first out, the gross profit is $70 minus $45. $45 is the cost of goods sold. First in, first out. The $45 is the first inventory that goes in. Check the previous slide. The first inventory that goes in at 8th of February is at the cost of $45. So that's why the gross profit is $70 price minus $48. The first inventory in goes out, first out. So that's $25, the gross profit. The ending inventory is the 2 inventory lefts, $48 inventory and $51 inventory. So total, the ending inventory total value is $99. Okay, if the business uses last in, first out, and then the gross profit is equal to $70 revenue or sales minus cost of $51. Why cost $51? Because this method is last in, first out. The last inventory that goes in, according to the previous slide, is at the cost of $51 per unit. So $70 revenue minus cost of goods sold of $51 equal to $19. The ending inventory value according to last in, first out is $93. Why $93? Because the $93 is equal to the 2 inventory lefts according to last in, first out method. 2 inventory left according to this LIFO method is inventory at the cost of $45 and $48 equal to $93. And if you use average cost to calculate gross profit, remember you have to calculate the average cost first during the month. So average cost during the month is 144 divided by 3 units equal to $48. So very easy. The gross profit is $70 minus 1 unit cost or average cost $48. So gross profit equal to $22, and the inventory equal to 2 units of inventory times $48 average cost, so equal to $96. Argument for FIFO. Okay, there is one thing related to FIFO. The thing is, FIFO is in accordance with the flow, the physical flow of the inventory. So if you have a business, the physical flow of the inventory is like this. Whatever goes in first will be sold first. That is the logic of the physical flow. So FIFO is the most logic method. Most of the time, people say that using FIFO is related to more accurate balance sheet valuation, which is the current value of inventory. But there is one thing about the FIFO method, it results in highest income during period of rising prices. Sometimes in some accounting period, price of inventory rises very quickly. So if you use FIFO method, you will report highest income or highest profit. Because when you purchase the inventory at the beginning of the year, the price is low, so when you sell, you make good profit during the accounting year. So FIFO, most logic and according to the physical flow of the inventory, and FIFO, as far as I know, is the only acceptable method to calculate cost of goods sold according to accounting standard. So FIFO is the only one. But LIFO, there are several arguments that support the use of LIFO to calculate cost of goods sold. So see the first point there, if prices are based on current cost, results in best matching of revenues and costs, and therefore most useful income statement, closest to reflecting current or replacement cost of goods sold. So that is the argument. If you read the textbook, very difficult for me to explain everything in a short time. If you read the textbook, you will see in several businesses, LIFO is more appropriate way or method to calculate the cost of goods sold for the cost of goods sold. But like I said earlier, the only acceptable method according to the accounting standard is FIFO. If you have a business in the future, remember this: you can use LIFO if you have justification. If you can justify that LIFO is the most appropriate method for your business. If you have that justification, you can use LIFO. But most of the time, the accounting standard is only accepting the FIFO method. Argument for LIFO here. Using average cost or LIFO with a perpetual system. This is another thing. Remember, you have a recording system, perpetual method and periodic method. If you use FIFO, if you use periodic system to record inventory, you have no problem, because you will have to update the account inventory and cost of goods only at the end of the year. But if you use perpetual inventory system, the calculation for the cost of goods sold becomes complex, because when you sell something or you purchase something, you update the account inventory. At that time, you have to calculate what is the inventory that goes in or goes out. If you use LIFO, FIFO, or average method, then the calculation can be complex. That's the point that I think this slide is trying to point out to you. If I have a sample question, I will share with you. Let's say how there is a business. The business uses perpetual inventory system. At the same time, for calculation of cost of goods sold, the business uses LIFO method or FIFO method or average method. Then you will see the calculation can become a bit complex. I think this is too much for you. If I explain it will become very difficult for you. So if it is needed, I will share with you a sample question. Then hopefully you can see the differences that you have to do if you use Perpetual inventory system and FIFO method, LIFO method, or average method. Okay, now this is the last thing related to this topic. When do you report inventory below cost? Okay, see here. I have said earlier in this lecture, the value of inventory at the end of an accounting period is very important, because you have to show that value of inventory in the balance sheet of the business, and also you have to show that number in the income statement of the business. If the value of inventory that you reported or show in the income statement of the business has an effect on the net profit of the business. If you put wrong value, if you put over a higher value than you're supposed to show, then the profit will become there is an effect on the profit. If you put the value of the inventory lower than you supposed to show, it also will have an effect on the profit of the business. So remember this. In accounting, there is a principle called conservatism. The conservatism principle says, in accounting, you cannot overstate profit, and also you cannot overstate asset. You have to be conservative. This situation is like this. Let's say you have a grocery shop, and then at the end of the month or at the end of an accounting period, you do based on your recording, the value of your inventory is $5,000. Let's say based on recording, the value of the inventory is $5,000. But when you calculate, when you do the manual calculation of inventory, you found that $300 of inventory are expired products. So now, what is the amount that you have to show in your incomes? What is the value of inventory that you will show in your income statement and balance sheet? Is it $5,000 or $5,000 minus 300? The 300 is the expired items. So the answer is, you have to show the value of the inventory at $5,000 minus $300, equal to $4,700. You have to show the lower amount. You cannot show $5,000, even though in your record shows $5,000, but the actual value of the inventory is only $4,700 because $300 items are already expired. So you have when you show inventory in the income statement and balance sheet, you have to show at the lowest of at the lowest amount. Maybe there's a calculation here. At the you report inventory at net realizable value. Okay, net realizable value, there is a calculation for that. Lower of cost or market. So that the basic thing is like the thing that I have said. When you want to show or report your inventory in the income statement and balance sheet, you have to record it at the lowest of cost or net realizable value, the lowest number. If I have a sample question related to this thing, and I will share with you. This is gross margin method. I think I want to I'm not sure whether I have to discuss this in detail or not. Okay, this is gross margin method. This gross margin method is something like this. Sometimes there are businesses that sell many items, and they sell many items at the same time, small items. When they sell many items and small items, it is very difficult for them to calculate the actual value of ending inventory at the end of accounting year. I think the simple example is an easy to understand example is a hardware shop. Imagine if you have a hardware shop, you sell many small items like nails, nuts and bolts, small items. There are many small items in hardware, in a hardware store or shop. So sometimes it is very difficult when at the end of accounting year, if the business want to calculate, to do stock take or manually calculate the value of an inventory, very difficult for this business. So what the business can do is uses this gross margin method. Using this gross margin method, the business estimate. So see in this example, Pesan Brick has net sales for 1st of January to March 31st of $100,000, and net purchases is $65,000. Inventory on January 1st was $15,000, and a historic gross profit percentage of 40%. So for this business, it is very difficult for it to calculate ending inventory because the nature of the business is having small item or selling small items, and the quantity is very huge, many small items. So the business, when the business prepare the income statement, the business use gross margin method as method. So gross margin method, the business use estimate based on the previous year or history. Gross profit is 40%, so the business put the 40% as gross margin, and then calculate backwards to calculate the ending inventory. The ending inventory estimated in this example is $20,000. So that is the only way. Very difficult for the business to calculate one by one the small item inventory that they have. So this also can happen in businesses out there when they do accounting for inventory. So I try to now I will try to summarize everything. So when you learn about this topic 6, subtopic 3, you are learning about accounting for inventory. The first thing that you have learned is you have to know the definition of inventory, and then the next thing is you have to know that there are two account method to record inventory. There are two methods to record inventory. The first method is called perpetual method. The second method is called periodic method. Okay, perpetual method is a method to record inventory in which every time there is an increase in inventory or decrease in inventory, the account inventory will be updated. But if you use periodic system to record inventory, you only update account inventory at the end of the accounting period only. Okay, then the second thing that you have learned in this subtopic is you learn about how to do costing or to calculate cost for the cost of goods sold. The cost to calculate cost for the item that or product that a business sell at one date. So if you want to calculate the cost of goods sold, there are three methods that can be used, or you have to know. Three methods that you have to know. The first one is called FIFO method, and then the second one is called LIFO method, and the third one is called average method. Only FIFO method is acceptable according to accounting standard, but still you have to learn LIFO method and average method in case this method is suitable or appropriate for your business. Okay, and the next thing that you have learned in this topic is when you show or report the value of inventory in your income statement and balance sheet, you have to show it at the lowest between cost and net realizable value. You have to show the lowest amount because in accounting we have the principle of conservatism. The principle of conservatism says you cannot overstate profit. You cannot overstate asset and profit. So inventory is an asset. You cannot overstate asset inventory in your income statement and balance sheet. You have to report the value of inventory in the income statement and balance sheet at the lowest between cost and net realizable value. Thank you very much. This is the end of the lecture for this topic. Do not forget to write your name and metric number in the comment section. I will record that as the lecture attendance for today.